bank, and what does this mean for mortgage rates? Well, my name is Denise, the mortgage nerd, and I'm here to explain all the good, bad, and ugly. So as I jump in, the first thing I want to do is explain a little bit behind of how banks work and really how they make their money. Because you see, when people go to the bank and they deposit their paychecks, whether you're depositing money electronically or physically, you're giving the banks your money. And what the banks do is they hold on to about 10% of that. They keep it in their vaults, and then they lend out the other 90%. And when they lend that money to consumers or businesses, they charge an interest rate. And that interest is the profit that they make off those deposits. And so what was happening with Silicon Valley is they received a lot of their deposits from local startups. In fact, their deposits tripled from 2018 to 2021. And what was interesting is that these investors were giving millions to these startups and they were depositing them at the bank, but the clientele around this bank didn't really need loans from the bank. And so what the Silicon Valley Bank did is they said, okay, how are we going to make a profit? If we can't lend this money out, then we have to find another way. And so what they did is they invested in bonds. So they took the money, they invested in the bonds, and what they were betting on, they were betting that the funds would hike their interest rates slower than what they did. So what does that mean? That means that basically, if you think about, if you were to go out and say, okay, let's pretend it was COVID and when everybody wanted a roll of toilet paper, right? And let's say you took your entire savings account and you were like, I'm going to buy all the toilet paper rolls that are selling for $5 a roll because they were in such high demand that it increased the cost of the toilet paper. And you were like, I'm going to use my entire savings account and buy all these rolls. But then what happened is the demand went down, and as the Fed started increasing the federal funds rate, that's exactly what happened, is the demand for these bonds went down, and so it was devaluing their portfolio. Now they had all these toilet paper rolls that they spent $5 a roll on, and the current market value, let's just say, they could sell them for $1 a roll. And so nobody wanted the $5 rolls. They were just sitting on the shelf collecting dust. That's basically what happened. The bonds were losing value. No one wanted a portfolio of bonds at a 1.5% rate when the market was paying 5%. So when interest rates go up, banks pay more interest on deposits. And essentially, this is what I wanted to read to you guys. There was a warning that was issued of a possible downgrade in the bank's rating. And to avoid this, the bank sold its bond portfolio. So it sold all its toilet paper rolls at a $2 billion loss to raise money. This created fear, uncertainty, and doubt. So its stock tanked over 60% on Thursday. And then what I found most interesting is it said that the CEO sold 11% of his shares. The CFO sold 32% of its shares, and the chief marketing officer sold 28% of their shares in the last 2 weeks. So they knew that this were coming. They were running out of money. And what's scary is that FDIC insures everybody that deposits their money up to $250,000 of your money back in case something like this were to happen. And so what if you had $500,000 at the bank? Well, FDIC would only insure you up to $250,000. So boom, you just lost $250,000. And all these startups that had their accounts there that used the money to pay things like payroll and stuff, they were worried that they weren't going to have any money to pay the payroll. But the good news is that they announced on Sunday that they were going to go ahead and basically print money, because they said the taxpayer wasn't going to pay it, but they were going to print money to make sure that everybody would get their money back and that these businesses would be able to basically make their payroll. So what does this mean to you if you're in the market to buy a home? What did it do to interest rates? Well, let me show you. All right, so this is a look at the mortgage bond market. You can see right here is Thursday. Rates were hovering in the low 7% range, and then boom, Friday came out, and then look what happened today. The value of these bonds shot up. It caused mortgage rates to come down. So right now, the mortgage rates are hovering around that 6.6, 6.7 mark, when just Thursday they were in the low 7s. So what we're predicting is going to continue to happen is that we're predicting that these rates are going to continue to come down a bit. It really did shake up the feds that said, hey, okay, feds, you guys have been increasing the federal funds rate like crazy. It's time to pump the brakes, slow down. Look what's happening. You can't continue to do so. So the mortgage bonds are reacting, and what it means is interest rates are coming down. But if you bought a home in the last 12 months, you might be thinking, oof, now I'm going to pull the trigger and refinance. And you might get a bunch of spam calls and junk mail telling you now is the time. But as your mortgage nerd, I'm telling you, it's not the time to pull the trigger. They're going to continue to come down, and you don't want to pull the trigger too soon. Myself and the rest of the mortgage nerds, we have a redo loan program. It's zero out of pocket, but now is not the time. If you're shopping for a home, good news. But this decrease in interest rates is going to cause a lot of the buyers who are sitting on the sidelines to rush in, and you're going to start seeing, especially in the DFW area in Texas, you're going to start seeing those multiple offer situations come up because these people have been waiting for rates to come down. There could potentially be a buying frenzy. So if you've been on the fence, my recommendation is make sure your pre-qualification has been updated, call your real estate agent, and I'd re-engage in a conversation, because now might be the best time to hit the streets, lock in that sales price, and just know the sales price we can never change, but the interest rate we can. If you guys have any more questions or need anything from me, you know how to get a hold of me. As always, thanks for tuning in.